The recovery in risk assets has lost momentum, with trade war headlines cooling but far from over. With extended holidays in the US and Europe and a packed calendar of macro events and earnings, the question is, will volatility stay contained, or are markets sleepwalking into the next spark? I'm Johanna Bota, and joining us today to talk about the week ahead is Head of Global Content, John Kicklighter. John, thank you for being here with us.
Thank you for having me.
So with risk assets cooling off, what should we expect from the markets next week?
So the rebound that we had from a slightly less than expected aggression from the US based reciprocal tariffs is probably going to be short lived. I think we've seen as much of a bounce as we're going to get from any kind of short term relief. Now we have to, if we want to keep carrying the markets forward, move towards enthusiasm. And that's going to be very difficult to register because we still haven't resolved tariffs. The reciprocal tariffs for the rest of the world, non-China, is a countdown of 90 days. So they're still negotiating, and so far the negotiations haven't sounded particularly encouraging. If we hear from the likes of Japan, for example, or the EU, and it doesn't seem like either U.S. or China are backing down, and those are two large players. So if this continues and then if this uncertainty is maintained, we are just going to keep walking into the global macro evidence of this being an issue. So we get into retail sales, we get into consumer confidence, we get into business confidence, but very very prominent standing next week. We have very uniform, meaning more globally, growth forecasts from a reliable source as far as that goes. And that's probably going to be a wake up call for markets, and they're going to have to really assess their sentiment and their risk in a thinner liquidity week.
And you mentioned we have a huge sense of unease right now. We are awaiting tariff announcements. We have a growing worry about the economy. What markets should we be looking out for?
So we should always look at the traditional markets, the ones that are really representative of sentiment. And I think that if you really had to boil it down to one, and often people ask me what should I look for if I'm trying to gauge global sentiment of risk on, risk off, as the usual term, I would say something like the S&P 500 is a good indicator because it's representative of the largest economy in the world. It is one of the most heavily traded assets through derivatives. So the S&P 500 is a good measure, but you can always look at major indices around the world and major economies. We can look at things on the more extreme end of the risk curve. So that would be something like Bitcoin, because it's more of a speculative asset for most people who trade it. We can also look at, obviously, the dollar. But I think a couple of things to really target into the next week, given this backdrop. I would say definitely focus on the USD CNH. I know it has some controls to it from the Chinese side, but that US dollar yuan exchange rate is really at the forefront of the pressures that these two countries are putting on each other. So this is something that you want to see, and it's not necessarily immediately indicative of what the market sentiment is necessarily, but it's telling us a little bit more about what the regulators and government are willing to do in this back and forth between these two countries. I would also say watch gold. Gold is definitely drawing a lot more of that safe haven status away from the likes of the US dollar and US treasuries. So how much of that it is drawing away, because something like the dollar is always a relative asset. So Euro USD or dollar yen, you don't really get that pure movement away from traditional fiat that is being obstructed by these policies. So gold is a more consistent, historically alternative to traditional fiat and dollar. And of course, I would say watch the VIX. It is going to be increasingly sensitive, especially in these thin market conditions where we might curb trends because we don't have really deep markets. We don't have a really clear and unadulterated theme. A lot of fear and speculation is going to make it choppy. But in thin conditions, something that comes to the surface, like a headline, can generate some very sharp movement in the markets.
Speaking of that, next week, it's a busy economic calendar week. What's the key event risk lineup for next week? Can you walk me Monday through Friday, please?
Sure, sure. So it's an uneven event risk week, which is going to make it a little bit more interesting. Obviously, on Monday, we have Europe still offline because they have the extended holiday. The US and other countries do not. So that inconsistency will provide some thinner liquidity, but it doesn't mean that we're without event risk. I would definitely watch something like the start of the IMF World Bank spring meetings, because that is going to lead to some more crucial event risk the next day. But you also have something like the conference board's consumer confidence or leading indicator, which it's not necessarily paid much attention to, month over month, but it has been consistently a unimpressive indicator for many months, for the world's largest economy. So even before these tariff headlines became more prominent, so definitely keep that on radar. But don't expect trends to develop on a Monday. Maybe some volatility for sure if there's headlines. Tuesday is where I think we start digging into what the principal theme is now, as long as there isn't an escalation in trade wars. Or Donald Trump says he's investigating ways to get rid of Jerome Powell as the Fed chairman. If these normal conditions hold, then we are going to definitely be watching something in order of the World Economic Outlook and the Global Financial Stability Report, which are the two reports that come from the IMF semi-annually. So this is that consistent GDP forecast and financial stability concerns that this group will present. The last time they updated, they had an update in January. In between the full updates, they did upgrade growth. They did upgrade growth globally. They upgraded growth for the U.S. by, I think, 0.5 percentage points. And I think that those are both going to take a significant hit. We've seen some significant downgrades in growth forecasts from the likes of PIIE and other groups. So I want to see what they do. And I think the markets are going to pay a lot more attention to these reports in this go around. So Tuesday is really where we're kicking off that global growth consideration. Wednesday, I would say we're getting still into growth because we're seeing the PMIs for April for the major developed economies from the US, Japan, Australia, Eurozone, UK. Those updates are going to be very timely, but they're not going to be as influential as the forecast that we get on a Tuesday. Nevertheless, you want to level set and you want to set baseline expectations from this data as it tallies up in time, and we want to see what course we're on. On Wednesday, or sorry, before we get to Wednesday, Tuesday afternoon, Tesla earnings. We get into the earnings, and we want to see earnings. I mean, there's a lot you could say about Tesla. It's its own interesting asset, but you really want to see what it looks like in context of trade wars and recession risks. And the same is going to be true in the next day. We have Boeing earnings, and that's more of a Dow component or a blue chip. And it has had some headlines that were very unfavorable, that they are getting very clearly impacted, particularly in sales to China of their airplanes.
Yeah, they just canceled a huge order, right, from Boeing. So that
Yes.
obviously is going to impact it. What about Thursday?
So Thursday, that's when it starts lightening up a little bit in terms of like the heavy hitting stuff. But we will definitely go through business confidence. I think we have it for Germany and the UK and Turkey. We want to see how these countries' businesses forecasts are evolving. That is going to be of great concern. Also, U.S. durable goods, and we have the National Activity Index from Chicago Fed. So good overview. And then Friday, things are probably dropping off in terms of like the single ability market movers. But nevertheless, it's just all in context of how the trend is developing around the theme. And things like UK retail sales or Hong Kong's second quarter business confidence, Canadian manufacturing sales. And really, there's also a bonus in that we're going to get into the FOMC's blackout period, blackout period before its early May rate decision. So anything that we hear from the Fed, this is their last opportunity to kind of steer, especially because Donald Trump is not going to be quiet in the lead up to that rate decision.
Thank you, John. That's a lot of information to take in and a lot of things to look forward to. And thank you for watching. For more information on content like this, please don't forget to like and subscribe to our channel.